Good evening, everyone. How are you all? Good evening, guys. Good evening, Bhumika. Good evening, Rihanna. Good evening, son. Uh, we have completed the topic of ratio in the previous session. Now we'll be starting with a really interesting topic today, which is uh, cost of capital. So let's get started with the discussion about cost of capital. Let's understand in a very simplistic form uh, what's the significance of the business structure, or what's the significance of this subject of financial management, and then we'll understand how is this cost of capital going to be really relevant for us. The way I understand, or the way generally the finance guys understand the business as, it's a entity which acts like a intermediary. When we look at the business and capital thing, this business entity primarily its uh, activity, the main activity that the business is involved into is obviously creation of wealth for its investors. But the business is like it's going to get funds from multiple sources. Right? Business is going to get funds from multiple sources. And again, those funds are going to be deployed into multiple areas, which we can actually call as different businesses or projects. Right? So maybe you're getting funds from by way of equity share capital. Maybe you're getting it by way of issuing preference share capital, by way of debt. You're raising money from multiple sources. And this money that you have raised is going to be invested into multiple projects. Let's say project one, project two, project three. So that's how a typical business functions, right? Raising of money and application of money. And of course, with the sole intention to maximize the shareholders' wealth. This business model works on the sole intention or sole objective of maximizing the shareholders' wealth. Now, the question is when we are putting money into the projects, what do we expect in return? When we are putting money into projects, what do we expect in return? Yeah, tell me, guys. What do we really expect in return when we are putting money into multiple projects? What do we expect in return? Yeah, profit, return, right? Uh, so, let's say you're going to put money into these projects. So let's say you have invested uh, suppose 12,000 in first project, then 13,000 in second project, 15,000 in third project. So total investment made by the company is, can I say 30,000? Now mind it, this is 30,000. It can be 30,000 lakhs, it can be 30,000 crores. So investment made by the company is amounting to 30,000. Okay. One second. Okay, so total investment made into the different projects is, let's say, totaling to 30,000. Now, of course, on this 30,000, we would be expecting some rate of return. So let's say the company takes a project on this entire, we are expecting a rate of return of, let's say, 20%. We expect a rate of return of how much? 20%, right, guys? Oh, sorry, it's 40,000, my bad. 40,000. So rate of return that I expect on this project, on all this reality of 40,000 is 20%. Okay. Now the return that we expect is 20%. So in a simplistic way, we can understand that what's the return that we expect in INR terms or in monetary terms? What's the return that we are expecting? 40,000 into 20%. So that's 40,000 into 20%, which is 8,000 rupees, right? Now leave that monetary part, leave that 8,000 for the time being, just ignore that part. The money which we have put up 40,000 over here, we would have definitely raised it by way of equity share, preference share, and debt. So let's say we have got 40,000 invested, equity shares of 20,000, preference shares of, let's say, 12,000, and debt of 8,000. So that totals to 40,000, 20,000, 12,000, 8,000. That's total to 40,000. Right? This totaling is 40,000. Now tell me, since your rate of return is 20%, what should be the cost of these funds? Because anytime you're going to raise the money, 40,000, you're going to raise it from the market, but are you going to get it like free of cost? 40,000 is definitely not going to come to you free of cost, right? It is definitely going to be bearing some cost. It's definitely going to be having some cost. What do you expect? What do you think? What should be the cost of this 40,000? What should be the cost of this 40,000? Cost should be lesser, agreed. But how much? How much percentage? Can you quantify what percentage should be the cost of this total 40,000 that we have raised? What do you think? What should be the cost of this total 40,000? Should it be like more than 20% or less than 20%? Should it be more than 20% or less than 20%? Of course, less than 20%, right? So this fund, 40,000, has to be raised at a cost of less than 20%. Because when you're raising the money at a cost less than 20%, then only it makes sense. Because you raise money less than 20% and you invest it at 20%, then that's where your business is going to grow. That's where your shareholders are going to be profited. Right? So now the question arises. One part is, how do we measure this rate of return that we expect? How do we measure the rate of return that we expect on this portfolio or on these projects? That's 20%, right? Less than 20, the rate is 20%. Whereas when you are going to raise money from either of these three sources, the cost should be less than 20%. Right? The cost should be less than 20%. So if we say that the cost should be less than 20%, it's quite important to understand how do you measure the cost of these funds, right? And it's also equally important to understand how to measure the rate of return that you're going to earn. It's equally important for you to understand what's the rate of return that you're going to earn and also measure what is the cost of these funds. Now, in this chapter, we are going to understand how to measure the cost of the capital. Then we'll have a chapter of investment decision. We'll have a chapter of investment decisions in which we are going to discuss, in the chapter of investment decisions, we're going to discuss what should be the, how to measure this rate of return. Two aspects of business.
Hello.
Raising of funds. Right? Two aspects of business. One is investment, another is raising of funds. Okay. So here in this chapter, we are going to learn how to measure this cost. And second is how to measure the rate of return on the investment. That will be done in the chapter of investments. Right now, let us focus on how to measure the cost of capital. I hope you have understood what is the significance of understanding or calculating the cost of capital, right? Everyone, I hope you understand what is the significance of calculating the cost of capital. Why do we need to calculate the cost of capital?
Sir, I have one doubt.
Yep. Why do we like to know what is the cost of capital so that we can measure, so that we can actually take up the project which are giving us rate of return more than 20%. Like to put you to in front of your hypothetical scenario, let's say cost of capital is 18%. What will be your minimum required return from projects? So like if you're looking for investing in some projects, if your cost of capital, let's say you've computed the cost of capital as 18%, what is the rate of return bare minimum which you will be asking for in a particular project? Yeah, tell me. If you know that you're going to raise money from somewhere and that is going to cost you, let's say 18%, how much rate of return will you require from a particular project where the money is going to be invested? Of course, at least 18 or more than that, right? So the primary focus is before we go for selecting the project, we should know what is the cost of capital. Because unless we know what is the cost of capital, we may not be able to calculate, we may not be able to decide which project should be accepted. Like for example, you don't know anything of this, and you have in front of you, let's say 4 projects, right? In front of these 4 projects. So these projects are, let's say, going to earn you. One of them is going to earn you 10%, another is going to earn you 12%, another is going to earn you 15%, then maybe 13%. Now you have money to invest in each of these 4 investments, right? You have money to invest in each of these 4 projects. Which one should we really choose? Is project A suitable, or B suitable, or C or D? But obviously, we can say C is suitable. That's 15% highest, but then still we need to check what is the cost of capital. Like if I tell you my cost of capital is 17%, can you tell me which of these 4 projects are you going to choose? Which of these 4 projects are you going to choose? I say that your cost of capital is 17%, and these are the 4 projects that you won't be choosing any of them because my cost is 17%. How can I invest in projects which are giving me 10, 12, 15, or 13%, right? So merely looking at the project and saying that the highest return project should be chosen, something very much premature and naive to decide. So the essential part is first we need to fix what is our cost of capital, and then we need to evaluate which are the projects that are suitable for us. Are we good, everyone? Have you understood what is the significance of calculating cost of capital? Yeah. So let's go for understanding how do we calculate the cost of capital. Okay. So let us say there is a person who is looking to invest in a business. There's a person who's looking to invest in a particular business. Now, before he actually evaluates whether he should invest in business or not, he's obviously going to see how the funds are going to be reached. So let's say you want to start a business which requires an investment of 10 lakhs. Okay, so you want to start a business which requires an investment of 10 lakhs. If that business is going to require, let's say, 10 lakh as an investment, to say that 10 lakh is a money to be put in. Now this guy is looking for various sources of getting the funds. Uh, this guy is getting own funds. Okay, this guy is going to get own funds worth, let's say, 4 lakh. This person is having 4 lakh of his own money. This person is having 4 lakh of his own money. Okay, this guy is getting this 4 lakh, which is saved by him on his own. So own money is going to be 4 lakh. Now, from a company point of view, you can say this is something which can be said to be equity share capital, right? Now, you being a owner, you being an equity shareholder, won't you be expecting any rate of return from your business? Would you be needing some amount of rate of return from the business where you're going to put money? Yes or no? Of course, yes, right? So you would be like, okay, I'm taking a good amount of risk in this business, right? There will be obviously an opportunity cost of capital for me. I can put money into the other opportunities areas and I'll be able to generate some amount of return. So I say that this particular 4 lakh is having a cost of 15%. Because of course, the simple rule is high risk, high rate of return. So being an equity shareholder in the business, I'll require a higher rate of return, which is amounting to 15%, right? This is your equity share cap. You put your money as an equity shareholder and you expect a rate of return of how much? 15%. Then this guy actually starts asking for money from the friends and relatives. And of course, he approaches his parents. So he asks his parents that if you could please contribute some amount into my business. So parents are like, okay, we are ready to give a contribution of, let's say, 3 lakh, right? And the parents are saying now, okay, but you take 3 lakh from us, but you need to give that money back to us. Okay. You need to give money back to us, maybe after 5 years or 3 years or 2 years with a specified rate of return. Now, parents are obviously they are also owners, but they are not as good owner as equity shareholders. So parents are basically your preference share capital. Now, these preference share capital providers are asking for let's say 12% rate of return. Then finally, this person gets 3 lakh from debt. Okay. And this is going to be, let's say this 3 lakh is being raised at a cost of 10%. Maybe you're just taking a bank loan maybe in that case. So you can definitely see the total investment that is being made is 10 lakh into the business, right? And that has come from three different sources: from own funds, from parents, I mean, from the equity share capital, from preference share capital, and from debt or bank loan. So we are investing that 10 lakh into the business. Now, my question to you is, can you tell me, can you tell me what will be the minimum rate of return that you need from the business? Can you tell me what will be the minimum rate of return that you will need from the business? What will be the minimum rate of return that you will need from the business? Yep, tell me. I mean, how much rate of return should the business give actually? 6%, 15%. Okay. Anyone? See, we have got funds from three different sources: equity share capital, preference share capital, and debenture holders. Equity shareholders need 15% rate of return. Debenture holders need to be given 10% rate of return, and preference shareholders need to be given 12% rate of return. So, now my question to you is, what should be the rate of return that you should be earning from the business so that all these investors are satisfied, or all these investors' claim is fulfilled? 12%. Okay. Let me just put it other way around. Capital amount Then I'll talk of cost. Capital is equity share capital, preference share capital, debentures. Amount is 4 lakh, 3 lakh, 3 lakh. Total is 10 lakh. Okay. Then we have the cost. Equity share capital has got a cost of 15%. Preference share capital is a cost of 12%. And debt is a cost of 10%. 15%, 12%, and 10%. These are the costs. Now, if I ask you, sir, on this 4 lakh, the equity shareholders are expecting 15% return. Can you tell me what is the return in rupee terms or expected return in rupee terms for the equity shareholders on their 4 lakh capital? How much return, how much amount are they expecting to be their income? 60,000? Can I say you simply did that as 4 lakh into 15%, 60,000? Same way, what's the rate of return for preference share capital? I mean, what's the amount of return for preference share capital? What's the amount of return for preference share capital? 36,000. And what's the amount of return for debenture holders? 30,000. So in total, on this entire 10 lakh, what's the return that you're expecting? On this 10 lakh, what is the total return that you're expecting that you need to pay to your finances? Yep. Can I say it's 1 lakh 26,000? So the rate of return on total funds. Rate of return on total funds is, can I say 1 lakh 26,000 upon 10 lakh? 1 lakh 26,000 upon 10 lakh. What is the number? 12.6%, right? Right? Yeah. So can I say 15% of 4 lakh plus 12% of 3 lakhs plus 10% of 3 lakh? All three of them translates to, all three of them translates to 12.6% of 10 lakhs. Right, guys? So this 12.6% is something which we call as overall cost of capital. Right? Or we also call it as total cost of capital. Or we also call it as weighted average cost of capital. So either of we call it as overall cost of capital, total cost of capital, weighted average cost of capital. That's the cost that we are looking at from the holistic perspective. Okay. Now, why do we call it as weighted average? So let me just put in front of you something different of sort. Why do we call it as a weighted average? Let me just calculate this number in a bit different way. We have like amount and the cost. I can just just slide this amount a bit, and then I'll start with giving you the weights. Weights are 1. Total of weights should be 1. Now this 4 lakh out of 10 lakh. The weights are going to be 0.4. So how do we get this weight? 0.4. 4 lakh out of 10 lakh. 0.4. Then the next weightage will be 3 lakh out of 10 lakh. So 3 lakh out of 10 lakh, that will be 0.3. The next is also going to be 0.3. Now, I hope you are very clear about how to get the weighted average. What's the formula for getting weighted average, guys? What's the formula to get weighted average? Do we know? Yes or no? How do we calculate weighted average? Weighted average will be summation of weights into x upon summation of weights. Over here, can I say it is summation of weights into cost upon summation of weights? Of course, weights are totaling to 1. So we can say weights into cost. So let's calculate weights into cost. Weights into cost means 0.4 into, we have like 0.4 into 15%. That's like 0. Or you can say 6%. 0.3 into 12%, that's like 3.6%, and 3%, totaling to 12.6%. Weighted average, you can say it's simply 12.6% upon 1. So answer is 12.6. Your overall cost of capital, total cost of capital, weighted average cost of capital is all one and the same. Right? Weighted average is something that we have already learned in foundation. Is taken as summation of weights into x upon summation of weights. It's like we are assigning 40% weightage to this cost, 30% weightage to 12%, and 30% weightage to 10%. On an average, we can simply take the product that's weights into cost, right? That should be equal to weights into cost. Weights into cost, that total of that is going to give you the weighted average number. Okay. Are we clear, guys? So you can calculate the weighted average by either taking it in this way, where you multiply and then you take a division, or you can also calculate using this method. I'll just give you an example so that you can calculate it again. So let's say we have got capital, amount of that capital, and cost. So let's say we've got equity share capital. There are some reserves, and we have preference share capital, loan, and debenture. Equity share capital amount is, let's say, 10 lakh. Reserves are 5 lakh. Preference share capital 8 lakhs. Loan is for 12 lakh. And we have debentures of 15 lakh outstanding. Cost is 16%, 16%, preference share capital 14%, loan is 12%, and debentures are at 9%. Can you calculate the weighted average for this? Can we calculate the weighted average cost for this, for example, guys? Can we calculate the weighted average for this example? Yep. Calculate the weighted average for this, guys, for this example. Give me the weighted average number for the example that I have stated. First, you need to calculate the weights. Weights are simply like you have the amount and then total. So what's the total of amount? Total of the entire amount. It's like 10, 15 plus 15, 30. I think 50 lakhs. Right? So you can say weightage is 0.2, which is, of course, 10 lakh. 10 lakh divided by 50 lakh. Then it's 5 lakh divided by 50 lakh, which is 0.1. Then this is 8 lakh out of 50 lakh, which will be 0.16. Yep. 12 lakh, that's 0.24 and the 0.30. Right? Then what you do is simply take weights into cost and just take the total. We have the amount of weights, we have the amount of cost, just multiply. So what's the total? Just give me the answer. What happened, Chirandeep? You can just text me if you have any queries because we'll allow you to speak at the end of our session. Okay, so weighted average is 12.62%. Are we all getting this number? Weighted average 12.62%, guys. Yes or no, guys? Yes, 12.62%. Everyone getting this answer, 12.62%. Okay, great. So that's one part of computing the average cost of capital. Now the next step is, sir, how did you calculate this individual cost of capital, like 16%, 14%, 12%, 9%? How did you calculate this? Yep. How do you calculate this? 16, 16, 14, 12, and 9? Right. So that's our next agenda, by the way. We need to calculate each of these numbers. We need to know how to calculate the cost of each of these items. And in that, we are going to get started right now with the methodology to calculate cost of debt. Today's session, we are going to look at the various ways to calculate cost of debt and cost of preferential also. And then cost of equity, we'll be doing it in the next week's session. Okay. So cost of debt now. How do we go about calculating the cost of debt? Let's start it with a very basic thing. Okay. Let's say we talk of a debenture. Talk of a debenture which has got a face value of 1,000, and this is issued at a premium of, let's say, 10%. Okay, the face value is like 1,000, issued at a premium of 10%. So we've got the debentures, 1,000 face value, and this is issued at a premium of 10%. And we say coupon payment. Coupon payment is going to be 120 per annum. Every year, you're going to pay a coupon, or you can say interest of 120 per annum. So coupon is 120 rupees per annum. Coupon payment is 120 rupees per annum, which is the amount of interest. Interest or coupon payment is amounting to 120 per annum. And we are saying that this particular debenture is a irredeemable debenture. What do we understand by irredeemable debenture, guys? We know what's a irredeemable debenture? We know what's a irredeemable debenture, yes or no? Never redeems, right? Which is, the principal amount is never going to be paid out. You will keep on receiving the interest payment till perpetuity. So till the company is in existence, interest will be, the company is remaining in the entity, the coupon will be paid by the company. That's where we see it's irredeemable. It's never going to be redeemed. Okay. So what about any sort of coupon? Coupon is basically your monthly, not monthly, annually, the amount of principal amount of interest that is going to be paid by the entity to the debenture holders. Now my question to you is, this irredeemable debenture principal is never going to be repaid. Right? So principal is never going to be repaid. No? Yeah. This principal is never going to be repaid. Okay. So how do we calculate what is the per annum cost for us? What is the per annum cost for us? How do we calculate the per annum cost? Yeah. How do we calculate the per annum cost? 12%? Is the per annum cost 12% in this case? No. The simple fundamental rule that we follow to calculate the rate of return, or to calculate even the cost of capital is, it's simply going to be, the rate of return will be like return upon the principal amount. So over here, cost of debt is going to be computed as interest upon net proceeds. Tell me, on this debenture, what is the amount of interest that will be paid by the company on its debenture? What is the amount of interest that the company is going to pay? 120? On how much? After getting how much of principal, the company is paying an interest of 120. After getting how much amount of principal is the company paying 120 interest? 1100. Exactly. That's exactly true. Because we are actually having a face value of 1000, but the debentures are issued at a premium of 10%. So obviously, we would have received 1100. And the interest that we are receiving on that is 120. Cost of debt, and we want to calculate the cost of debt, that's 120 upon 1100. How much is this answer? What's the answer? 110 divided by 120 divided by 1100. That's 10.91%. That's 10.91%. You would be getting like 0.10110909. I'm just making it in terms of percentage. So in percentage terms, that's 10.91%. Cost of debt is 10.91%. Where we simply said that it's going to be interest upon net proceeds. Right? So it's as simple as that. Whatever interest you pay, that's in the numerator. Whatever principal you have received, that's in the denominator. 10.91%. 91. Simple. Now, I need to make you understand one important concept over here, wherein we are going to talk of taxation. Okay, we are going to talk of tax effect. Now, we're looking at tax effect of interest. Tax effect of the interest. Now, what is this tax effect of the interest? Suppose we had a company which was without any debt, and we have another company which is having some amount of debt. Both companies are having a similar EBIT. Both companies are having a similar EBIT, which is earnings before interest and tax. So both companies are having a EBIT of, let's say, 10,000. The company without debt is also having 10,000. The company with debt is also having a EBIT of 10,000. From this EBIT, we are going to subtract interest. Now tell me, which of these two companies will have an interest expense? Which of these two companies are going to have the interest expense? With debt one, right? So of course, there's no interest expense in the first company. In the second company, there's an interest expense of, let's say, 3,000, or let me make it as 4,000. So that will give us a profit before tax of 10,000 and 6,000. So we subtract the tax, let's say tax at the rate of 30%. So if it is without debt, what is the amount of tax that needs to be subtracted? On 10,000, what is the amount of tax that needs to be subtracted? 3,000, 30%, 3,000. Can you tell me what is the amount of tax in the second case? What is the amount of tax in the second case? 1,800. That gives us a profit after tax of 7,000 and 4,200. Now, if I ask you, you can do this table and tell me what is the cost of, what is the interest cost? What is the cost for the company uh, which has got a debt? Can I say that 4,000 is the cost for the company which has got debt? Yes or no? As compared to a company without debt, when we look at the company which is having debt, do we mean to say that the cost for that company or extra expense for that company is 4,000? Can we say that it is 4,000? Yes or no? Well, if you say that 4,000 is the cost, just look at how much is the reduction in the PAT due to the debt. The company which is having a debenture as compared to the company which is not having debenture, what is the reduction in the PAT? The PAT reduces, can I say by 2,800? The PAT reduces by how much? 2,800. So can we really say that 4,000 is my cost? No, we cannot say the cost is 4,000. I can definitely say that comparing this, the cost is 4,000, right? Whereas if you look at the tax, what do you think? Is there a saving in tax? Is there a saving happening in tax? Yes or no? Is there savings in tax? What is the amount of tax saving? There is a tax saving of 1,200. So if I ask you what is the net cost. The amount of net cost. What's the amount of net cost? Yep. The amount of net cost. Net cost, because you have a cost of 4,000 and you have got like the amount as what? Net cost is 2,800, right? Correct? Yes. The net cost stands as 2,800 because your cost is 4,000 and your savings is 1,200. Cost is 4,000 and savings is 1,200. So that amounts to net cost of 2,800, right? So to compare a company which has got a debt, is having a cost of 4,000. But instead of paying 3,000 as tax, this company is paying 1,800 as tax. Can I say the company is saving 1,200 in tax? So your cost is 4,000, but you're also saving 1,200. The net effect is 2,800. Did we get it? Yeah. Did you get it, guys? Yeah. So net cost is 2,800. So if I want to explain you, how is this net cost of debt arrived at? Net cost of debt, as I said, it is 2,800. This is arrived at what? 4,000 minus 1,200. This is nothing but 4,000 minus 40%, not 47, 30% of 4,000. This 4,000 is nothing but interest minus 0.3 into interest. That's like you take interest common outside, interest into 1 minus 0.3. So I can say it's a net cost of debt is interest into 1 minus t, where t is the tax rate. What is t? T is the tax rate. So interest into 1 minus t, that is t equal to interest. T is the tax rate. So basically, it's like after tax cost of debt. So here, if you want to say what is the KD? KD means we're talking of after tax cost of debt. Formula we have stated that it is interest upon net proceeds. That's what we have computed, right? 120 upon 1,100, interest upon net proceeds. But here you were assuming, that the net proceeds, or I can say that you were assuming that this is going to be before tax, I mean without tax. But when I bring in tax, I need to make it as interest into 1 minus t to give the after tax effect of cost of debt. Because we'll be saving money when it comes to taxation. The cost of debt for computing after tax cost of debt, the formula is simple. Interest into 1 minus t upon net proceeds. Right? Romit Kaur is asking, why are we subtracting that 1,200? No, we are not paying. We are not going to pay this 1,200 because when we are looking at a company which is having debt, it is going to pay instead of 3,000 only 1,800 as tax. So that 1,200 is a savings for the company which is having debt. 1,200 is a savings for the company because it's not going to pay anywhere else. Right? Being a company with debt, you will be claiming this 4,000 as expense, and you will be like saving 1,200 of tax. And therefore, your net cost works out to be 2,800. But there is an outflow and inflow nil. No, there is an outflow of 4,000. There is an outflow of 4,000 and you're saving 1,800. Right? So there is a saving. Instead of paying 3,000, you're going to pay 1,800 only as compared to the company without debt. So just because you have taken debt, there is definitely a outflow of 4,000. but there is also savings of 1200. And therefore, you say, as compared to the company which is not having debt, the company which has got a debt, there the profit is reducing only by 2800. So your real cost, I mean, the net cost which you are suffering, net cost which you are bearing is ultimately 2800 because your profit is reducing by that much. So what is the effect of you taking debt? The profit reduces by 2800, right? So therefore we said 2800 is my cost. Okay. Net cost of debt. Net cost of debt is simple. You're having a 4000 cost, right? Because you have taken a loan, so you're going to pay interest of 4000 and you're going to save on interest. So your net will be net effect of both cost that you're bearing, the cost that you're paying, and the profit, I mean the savings that you're having. The net effect of that is 2800. Okay. So that's the formula for KD, or after tax cost of debt, with interest into 1 minus T upon net proceeds. KD stands for cost of debt. We'll also see KE standing for cost of equity, KP standing for cost of preferential, KR for cost of reserves. Right? So these are the standard notations that we are looking at. Okay. Now this is with regards to those debentures which are irredeemable. Now we may definitely have debentures which are redeemable in nature. What do you mean by redeemable debentures? What do we understand by redeemable debentures? Yeah. What do you mean by redeemable debentures? Which can be redeemed, which can be redeemed, or which will be redeemed? For you mean to say which can be redeemed or which will be redeemed? Redeemable debentures on maturity, exactly, which will be redeemed, right? Will be redeemed. So on maturity, the debenture principal amount will be given with interest. Perfect. So if you look at the cost of redeemable debentures, how are we going to really think of it? See. So I hope this particular portion is clear. This was for cost of irredeemable debentures. Now we are looking for the method to compute cost of irredeemable debentures. Cost of irredeemable debentures. So or put it this way, no? Face value of a debenture is, let's say, 1000 rupees. We have got a debenture with a face value of 1000. Okay. Face value is 1000, on which interest is going to be paid as rupees 130. Okay. Then we have like this is 1000 is issued at a premium of 5%. So face value of 1000, which is issued at a premium of 5%. Redemption is going to be rupees 1100 in 5 years. These debentures are going to be outstanding for a period of 5 years. These debentures are going to be outstanding for a period of 5 years with a redemption value of 1100. Face value is 1000, issued at a premium of 5%. Interest is 130. Redemption is 1100 in 5 years. Redemption is 1100 in 5 years. Okay. Sorry, I think I made a mistake. This is going to be, yeah, redeemable debentures. The cost of redeemable debentures, we are definitely going to redeem it. Now, when we are going to redeem it, we issued it at a premium of 5%. Interest is 130 and redemption is 1100 in 5 years. Now, if you think of from the company's point of view, from the company's point of view, we have like what is happening in year zero? What is happening in year zero? From the company's point of view, when the company issues these debentures, is the company going to receive some amount or is the company going to pay some amount? When the company is issuing these debentures, is the company going to receive something or pay something? It's going to receive, right? There's going to be an inflow. How much is going to be the inflow wise? What is the amount of inflow? 1050. Perfect. And then from year 1, 2, 3, 4, 5. In each of these 5 years, what's going to be the cash flow position for the company? Inflow or outflow? What is going to be the cash flow? Inflow or outflow? Yeah, there's going to be a inflow, right? Or outflow? Outflow. Okay. So it's going to be an outflow of 130 every time. What about the cash flow in year 5? What about the cash flow in year 5? I can say there will be a coupon outflow of 130. Also in the 5th year, there's going to be a outflow of 1000 face value. Is it? No, because you're going to have a redemption of 1100. So I need to obviously pay 1100 at the time of redemption. If I ask you, what is the cost of this type of debenture? Because it's not like a irredeemable thing where you're going to get this 130 till perpetuity. It's not like a irredeemable debenture where you're going to get this 130 till perpetuity, right? So if I ask you what should be um, the cost over here, is it correct to state over here? Now I'm just not bringing the taxation over here. Is it correct to say that our cost of debt is just 130 upon 1050? Is it correct to state this 130 upon 1050? No, it's not. Because first up, I need to calculate what is the cost in rupee terms. Or rather, I can say what is the cost per annum. What is the cost per annum in rupee terms? How much is the cost per annum, guys? How much is the cost per annum? Every year, do you mean to say I'm having just a cost of 130 rupees? Or is there any other cost also? Is the cost only 130 rupees? Or do we have some other cost? You see any other cost in the company? Is 130 the only cost? Do we have a premium? Yes, of course. Just have a look at it. You're getting 1050 and you're actually paying out 1100. You're getting 1050 and you're paying out 1100, right? So are you paying anything extra over and above what you have received? Paying anything extra over and above what you have received? Yes. How much are you paying extra? How much extra are you paying over and above what you have received? 50. But is that 50 your expense for a particular year, or is it an expense for all the 5 years? Is that 50 an expense for one of the years, or should it be treated as an expense for the entire tenure of 5 years? Can I say for all the 5 years, right? So cost per annum, when I say, it should be 130 plus 50 upon 5, right? So ideally, the cost per annum will be 130 plus 10, which is 140. Cost per annum in rupee terms is 130 plus 10, which is 140. You getting it, everyone? Yep. Cost per annum in rupee terms, it's going to be 130 plus 10, which is 140. I hope this part is clear. So I can just now formulate it quickly. I can say this interest is, 130 is the interest, plus this 10 is something which we have got as redemption value minus net proceeds upon number of years. Does it make sense for you guys now? Because this 50 has been arrived as 1100 minus 1050. This 1100 is nothing but your redemption value, and 1050 is your net proceeds. Essentially, cost per annum in rupee terms is going to be interest plus redemption value minus net proceeds upon n. Into redemption value minus net proceeds upon n. Make sense, everyone? Yeah. Okay. Now, what is the principal amount? Because if I want percentage cost per annum, it should be obviously cost per annum in rupee terms, percentage cost per annum in rupee terms, right, divided by percentage cost per annum. We can compute it as cost per annum in rupee terms, divided by principal, divided by the principal. What should be the amount of principal? Should I take the amount of principal as 1050, or should I take the principal as 1100, or should I take something else? The denominator, should I take the amount of principal as 1050 or 1100, or should I take something else? So 1050 is also correct, 1100 is also correct. But if you take average of both, that will be the best one, right? So I can say this is cost per annum in rupee terms upon average principal. Cost per annum in rupee terms upon average principal. Now, cost per annum in rupee terms is basically interest plus redemption value minus net proceeds upon n. How do I get the average principal? Average principal will be redemption value plus net proceeds by 2. Redemption value plus net proceeds by 2. So we are not taking the net proceeds. We are neither taking the redemption value. Rather, what are we doing is we are going to take the average of. And this is our cost of debt formula. I can refine it further by making it an after-tax cost of debt. So making it after-tax cost of debt which is equal to KD. That's interest. We're going to make it after tax. So interest will be multiplied by 1 minus T plus RV minus NP upon N, the whole divided by RV plus NP by 2. Okay, that's our cost of debt formula for uh, the redeemable debentures. Okay. We good with this formula? So suppose if I tell you we have a redemption value of 1050, net proceeds of 1025, interest is 100, tax rate is 40%, and number of years is, let's say, 5. Can you calculate the cost of debt, guys? The answer for this cost of debt by applying this above formula. Apply this formula and give me the cost of debt. The cost of debt, guys, applying this formula. Just substitute the numbers in it and try to get the cost of debt. Yeah. So we'll have like formula, if I apply the formula, that's going to be 100, 1 minus 0.4, plus redemption value is 1050, net proceeds is 1025 divided by 5, the whole divided by 1050 plus 1025 by 2 is 60 plus 1050 minus 1025 divided by 5, which is of course 5, and then we have 1050, it's 1037.5, 60 plus 5 divided by 1037.5, that's equal to 6.6%. The cost of debt. Are you able to get these, guys? Are you following this? Are you with me? Yes. Okay, perfect, guys. So we have got the two formulae to be done for today, which is cost of debt. That's simply computed as interest into 1 minus t plus rb minus np upon n, the whole divided by rb plus np by 2. And if it's irredeemable, then that's interest into 1 minus t upon net proceeds. Okay, so with that, let's just take a break right now. Break of 15 minutes. We'll come back and then take up the cost of preference shares and also discuss something about the YTM method of calculating cost of debt. Okay, let's take a break. Well, there, guys. Okay, so we have seen the formula to compute cost of debt um, by way of irredeemable as well as the redeemable debt. Now, let's take it forward for further discussion. Which is calculating this cost of preference share, right? Now, the formula for cost of preference share is similar to that of cost of debt, with the only difference being there's no tax saving on preference shares. So, cost of preference share, which is denoted by KP, is going to be calculated as preference dividend upon net proceeds for irredeemable preference shares, right? And then this is, if it's a redeemable preference share, then the formula goes as preference dividend plus RV minus NP upon N, the whole divided by RV plus NP by 2. Right? So preference dividend is not a tax deductible expenditure. Preference dividend is not a tax deductible expenditure. So therefore we say it's just we just need to take the preference dividend without any tax benefit out of it. Without any tax benefit, we can say the formula is similar to that of cost of debt. It's just that 1 minus t, the addition 1 minus t which we had, that is ignored. Okay. Fine. So that's the voice is very low. Second. Is it okay now? No? Okay. The cost of preference shares, it is preference dividend upon net proceeds, and if it's a redeemable thing, or I can say for redeemable preference share, that's going to be preference dividend plus RV minus NP upon N, the whole divided by RV plus NP by 2, or I can say average of it. Okay. Now, this is the similar formula, so I'm not focusing more on that. What we are really looking at is calculating the cost of debt using yield to method or YTM method or IRR method. Okay. So let's try to build on that concept. Cost of debt using IRR or YTM method. It's cost of debt using IRR or YTM method. Okay, so now how do we go about understanding this YTM of IRR and IRR YTM method? What is this? Let's try to build it from a very basic. So suppose if I tell you we have cash flow like this year, and obviously this from the point of view of company. In year 0, the company is receiving 1,000 rupees, and in first year, the company is paying out 1080. Can you tell me what is the cost of debt to the company? What is the cost of debt to the company? 8%, right? What is IRR? What is YTM? Nagaratna, I'll just let you know. YTM is yield to maturity. IRR is internal rate of return. Okay, so cost of debt to the company, we can say cost of debt to the company. You're saying it's, Bhumika is saying it's 8%. Absolutely correct. I can calculate this cost of debt to the company by simply using this formula. A is equal to P into 1 plus I raised to N. Right? So cost of debt is A is equal to P into 1 plus I raised to N. The A is 1080. This is equal to principal of 1,000 into 1 plus I raised to 1, because the tenure is 1. So 1.08 is equal to 1 plus I. I will be like 0.08 or 8%. It is simple. Now let me just put it in a different way. So here 0, you're getting 1,000, and directly in second year, you're paying out 1150. So you're paying out 1150. Can you calculate the cost of debt over here? Can you calculate the cost of debt over here? Cost of debt. Remember, it has to be a percentage per annum. It has to be percentage per annum. Cost of debt, it's going to be a percentage per annum. Is it 15% per annum? No, this is not 15% per annum. So this is like amount is equal to P into 1 plus I raised to N. So amount is 1150 is equal to 1000 into 1 plus I raised to 2. Now solve this to get the value of I. Solve this to get the value of I, guys. It will be, of course, 1.15 is equal to 1 plus I raised to 2, which means 1.15 raised to half is 1 plus I. So I will be 1.0724. Simply means, I mean, that's 0.0724, which is nothing but 7.24%, right? That's 7.24%. Cost of debt, 7.24%. Are we all getting this? Yeah. Cost of debt is 7.24%. Now I can make you understand this 7.24% like this 1,000 becomes some value, and then it finally matures to 1150. So this 1,000 actually grows as 1,000 into 1.0724. So this becomes 1072.4 by the first year. And then this 102.4 becomes 1072.4 multiplied by 1.0724. That makes it as 1150. So every year, your amount of investment is growing by 7.24%. Every year, your amount of investment is growing by 7.4%. Is it clear? How did we get this 7.24%, everyone? Yeah. Okay. Now let me take it a notch higher. Suppose from the company's point of view, we have this set of cash flows. Year 0, you have, you're receiving, let's say 1,000. And finally, in third year, you're paying out 1440. Can you compute the cost of debt on a percentage per annum basis for this season? Yep. Get the cost of debt. Get the cost of debt base. Get the cost of debt, guys. What's the cost of debt? 9.54%. Well, the equation is quite easy. It's going to be 1440 is equal to 1000 into 1 plus I raised to 3. Okay, so we have 1.44 is equal to 1 plus I raised to 3. So this is like 1.44 raised to 1 by 3 is 1 plus I. So what is the cube root of 1.44? Cube root of 1.44. Cube root of 1.44, how much is it, guys? 1.095. Cube root of 1.44. Cube root, you need to get the cube root of this. 1.095. How to calculate the cube root? Okay, let me just tell you how to calculate the cube root. Just do as I say. Type 1.44 in your calculator. Then press root 12 times. Type 1.54. Press the square root button 12 times. Okay. After that, press -1, divide by 3, then +1. After that, into equal to 12 times. So it into equal to means multiplication equal to in combination of both 12 times. Just run this procedure and give me the cube root. Run this procedure and give me the cube root. You can also verify the cube root by multiplying it 3 times. Just run this and give me the cube root, guys. Okay, so that's 1.1292 is 1 plus I. So I is actually 12.92%. Got it, guys? I is 12.92%. So in this way, you can actually get any root, be it cube root, be it fifth root, be it seventh root, 11th root, any root. What you just need to do is in this step where you're going to divide, instead of dividing it by 3, you're going to divide it by 5 or 7 or 9, or whatever root you want. Is it clear, guys? Yeah. Yes, it's a time consuming process. You have to use it maybe once in an exam or maybe not also. So that's fine. Just one of the questions may require it because there's no other way to actually calculate this. There's no other way. Normal calculator. Okay. Oh, now let's just take it forward. Yeah, this is going to be really interesting now. Now, in all the three examples that we took, there were only two cash flows. One is an inflow, other is the outflow. We have an inflow, we have an outflow. We have an inflow, we have a outflow. There are only two cash flows. One is the inflow, another is the outflow. Now, we're going to look into a different aspect wherein we say year 0, 1, 2, and 3. Or let me just take it as 1 and 2 for the sake of simplicity. You're like, you're receiving 1,000, you're paying 120 in first year, and then you're paying out like 1150 the second year. Right? So how do we calculate the cost of capital over here? See, this is your present value. Now, this typical structure of the coupon or the cash flows, it has got two things. One is definitely getting the present value. I mean, 1,000 is the present value of the principal that you're receiving, against which you're not paying only once, you're paying twice. You're paying 120 in year 1 year, and you're paying 1150 in the second year. You're paying 120 in the first year and 1150 in the second year. So 120 is also the amount, and 150 is also the amount. Right? So we simply follow a rule wherein we say amount is principal upon 1 plus I raised to n. Can you tell me what will be the principal then? How do I write a formula for determining the, sorry, I did it wrong, right? That's principal into 1 plus I raised to n. So how do I get the principal? What should be the formula of P equal to? If A is equal to P into 1 plus I raised to n, what should be the value of P then? Yep, tell me. What should be the value of P? And that will be A upon 1 plus I raised to n. Right? So same way, in our example, 1,000 is equal to present value of 120 and present value of 1150. Present value of 120 and present value of 1150. Right? So 120 divided by 1 plus I raised to 1, and this is going to be 1150 divided by 1 plus 1 plus I raised to 2. So we essentially have this 1,000, which is a present value, will be equal to first year cash flow divided by 1 plus I, and second year cash flow divided by 1 plus I raised to 2. Now, ultimately, our objective is to calculate this I. Can you solve this and give me the value of I, guys? Because whatever I you are going to get, that's the rate of return. That's the cost of capital we are talking about. Can you solve this and give me the value of I? Give it a try, guys. Try to solve this and get the value of I. Yes. Solve this and try to give me the value of I. Point 9433. Are we really able to solve this? Is it really easy to solve this equation? Tell me, guys. Is it really easy to solve this equation? I mean, it ultimately becomes a quadratic equation, right? And it's a quadratic equation. Now, suppose by any ways you try to form a quadratic equation, you use your mathematical skills and try to solve it by using that quadratic root formula, which is minus b plus or minus root of b square minus 4ac upon 2a, right? But what if this is going to be for third year? Then this equation will extend to one more item, which will make it a cubic equation, even more complicated. It's like 4 years, then it becomes like a to the power 4 equation. So, this sort of equation cannot be solved with pen paper mode and trying to form an equation and solving out of it. Then how do we go about getting the value of I over here? Guys? Forget this, that you can solve quadratic. What if it's a cubic equation or it is a quadratic equation where you have raised to power 5? You cannot technically solve it. So can you just tell me how do we go about calculating the value of I? How do we go about calculating the value of I? Any idea? Okay, someone is saying using Chat GPT. You won't be allowed to use Chat GPT in exam. Okay. You need to use your own skills to get it. Logarithm? No, no, no. We are not going to use such high level of mathematics. Well, we are going to solve this by trial and error method. Okay, we are going to solve this by a way of trial and error method. That's the only way. That's a simpler way of solving it, right? So, how do we go about this trial and error method? See, if I is equal to, let's say, 12%, or I can say 0.12, can you tell me what will be the RHS value? RHS value will be 120 upon 1.12 plus 1150 upon 1.12 raised to 2. Give me this value. If I'm assuming that rate of return is, let's say, 12%, if I'm assuming that, let's say, the rate of return is 12%, so what is the value of RHS? 120 upon 1.12 plus 1150 divided by 1.12 square. So give me the value of this RHS. Give me the value of this, guys. Give me the value of this number. I mean, this expression. 120 upon 1.12 and 1150 upon 1.12 square. What is this values? 1023. 1023 point. Let me just check it out. 1.20 divided by 1.12. This is 107.14 plus 1150 divided by 1.12 square. That's 916.77. If I just add both of them, 107.14, that's 1023.91. 1023.9. RHS is standing as what? 1023.91, right? Are we getting this? But tell me, what is the value that we needed this? I mean, what was the value that we were targeting this to be? Is it 1023.91 or is it lower than that? Of course, we were looking for a value of 1000. When I took I as 12%, we got it as 1023.91. So, of course, is the 12% answer for us? Is 12% answer for us? No. So, is our answer of I more than 12% or less than 12%? Is it more than 10%? Sorry, more than 12% or less than 12%? Yeah. Is it more than 12% or is it more than less than 12%? Of course, it is more than 12% because when you're going to discount it at a higher rate, these numbers are going to be lower because these are denominator, right? So instead of 1.12, if you write a higher number, this is going to be lower and this may become closer to 1000. So let us say, let's take a 5% hike. So if I is like 15, not 15, let's say if I is 17%, which makes it as 0.17. So give me the RHS value, which will be 120 upon 1.17 plus 1150 upon 1.17 square. Yeah. Give me the value, the value of RHS at 17%. Give me this value, guys. 120 divided by 1.17 and 1150 divided by 1.17 square. What's the value? Give me the total value of this. 120 divided by 1.17 and 1150 divided by 1.17 square. How much is this? 942.65. That's 942.65. Right? 942.65. Okay. Now, what can you say about the answer? Is our cost of debt 17% or something else? Is our cost of debt 17% or something else? Of course, something else. Because we wanted this to be equal to what? 1000. Can I say we are in a situation like this? See, at a discounting rate of 12%, we're getting this as 1023.91. And when we're discounting at 17%, this is 942.65. So at 12%, it is 1023.91. At 17%, it is 942.65. Then tell me, can I say for a value of 1000, we will have the value placed over here? For a value of 1000, we will need some percentage to be derived over here, right? So where do you say that the cost of capital is lying? Can I say it is lying between 12% and 17%? Yes, somewhere in between 12 to 17. We need not take the average of directly as it is, but it somewhere lies within that range of 12 to 17%. Am I right, guys? Yes, are we getting this? Yeah. So how do we get that value now? Let's understand it in a very simplistic manner. So I'm just writing the rate and the LHS value or the RHS value. When we had the rate as 12%, RHS was 1023.91. And when we had the rate as 17%, then this is 942.65. So rate is 12% and 17%. And on the other side, you have RHS 1023.91 and 942.65. Right? So, what is the observed change? How much change are we observing? How much change are we observing? What is the percentage change that you're observing in the rate? What is the percentage change? Can I say we are increasing the percentage by 5%? That is leading to a decrease in RHS value by how much? That is leading to a decrease in RHS value by how much? That is leading to a decrease in RHS value by how much? 81.26, right? 81.26. But tell me, we changed this from 1023 to 941 by reducing it by 81.26. But what is the change that we really want? What is the change that we really want? We want to change it from 102391 to 1000, right? So what is the change that we wanted? By how much should this have changed? 81.26 instead of 81.26. This should have changed by how much? From 1023.91 to 1000. This should have changed by 23.91. So that's what I say, that instead of changing 81.26, if we would have changed it by 23.91, this is essentially our required change. Then, can you tell me what is the percentage change that was required? Yep. Percentage change required. And you do the calculation by simply cross multiplication. What is the percentage change that we needed? Percentage change that we needed. Can I say it will be minus 23.91 into 5 divided by minus 81.26. So see, tell me what's the percentage change that we needed? 23.91 into 5 divided by 81.26 is 1.47%. If our required change was 1.47%, can you tell me what will be the I value? I value will be, of course, 12% plus. Since it's a positive, we want a positive change. 12% plus 1.47%. This is 13.47%. So you can say this number over here is 13.47% because we wanted to increase this by 1.47%. 1.47%. That's 13.47%. Okay, this is the way wherein an equation like this can be solved. Cannot solve it by a normal quadratic equation or a cubic equation. That's going to be really, really difficult to solve, rather next to impossible. Rather, we should be doing it by way of estimation, trial and error. You write, you take a percentage, some random percentage, which would be like, looking at these numbers, you can just take an estimate. It's like investing 1,000 is giving me 120 first year and then additional 150 in the second year. You can just say, let's say, let's try it out at 12%. So 12%, you get a higher number. Then you take a number, I mean, a percentage which is 5% above your estimated number. That gives you 942, and you just need to interpolate between these two. Okay. Are we good, guys? And we understood how do we get this 13.47%? Yeah. Clear? Okay. Then would you like to try one question? Or if you wish to take it down, then just write it down quickly. Then we'll take up this slide it slowly. Just give you a couple of minutes to copy it down, because then we'll take one more question for your practice to understand how do we get this rate of returns. The way you are going to compute this return percentage are nothing but your internal rate of return or yield to maturity method. This is more precise, this is more mathematically accurate because it takes into account the compounding effect of interest. Okay, just quickly take it down. I'll just give you a couple of minutes to copy it down, and then I'll give you one more question for your practice.
Hello, sir. Hello, sir.
Tell me.
सर मेरी आवाज आ रही है आपको?
Yes, yes, I can hear you.
हेलो.
So query. 13.47, it gives 998.9. Yeah, Bhumika, there will be some errors. There will be some small slight error because of rounding up and other aspects. But that's the best way which you can calculate. And have you written it? Okay, then let me just give you another example that you'll be able to calculate this. So let's say we've got year and cash flow. So we have like year zero, wherein you are receiving, let's say, 900. And then in the next 3 years, you're paying out 100, and finally over here, you're paying out 1050. So the equation will be what? 900 equal to 100 divided by 1 plus I plus 100 divided by 1 plus I square plus 1050 divided by 1 plus I cube. Okay, fine. So get the value of I, guys. Get the value of I. So let's say first you start with at I equal to, suppose, yeah, let's take it as 12% only. Get the value of RHS. Get the value of RHS at 12%. That should be ideally 100 divided by 1.12 plus 100 divided by 1.12 square plus 1050 divided by 1.12 cube. Yeah, what's the RHS value? At 12%, what's the RHS value? Is it 916.35? Okay. So what should I do with this I? Should I increase the rate? Right? Should I make it like increase the rate from 12 to maybe 17 or 15, or should I decrease it? Should I increase it or decrease it, guys? Increase it, right? Because I want to reduce the total value. So of course, the denominator needs to be increased. So let's say at I equal to, let's take it as 15%. Give me the RHS value at I equal to 15%. I equal to 15%. Give me the RHS value, guys. Calculate and give me the value. Give me the RHS value at I equal to 15%, guys. That's 852.95. Just verify it. It's 852.95. Two point nine five. Yeah. So if you go ahead with the interpolation, you can simply use the same method. Therein we say at 12%, 15%, that's 916.35, and it's 852.95. And we want it like value to be 900. So you want to know this value. We'll talk of rate, right? Talk of rate and then the RHS value. So rate 12%, RHS is 916.35. At the rate of 15%, RHS is 852.95. Point difference is okay, Patrick. That's fine. Some decimal difference is fine. So what is the change that we are observing? Observed change is plus 3%. And what is the change in the RHS? Change in the RHS, the difference. 916.35 minus 852.95. What's the difference, guys? 63.4. Okay. And what is the required change? There's a fall over here. Required change was minus 16.35. Right? So what is the required percentage change then? Required percentage change will be 16.35 into 3 divided by 63.4. Required percentage change. How much is it? Required percentage change 16.35 into 3 divided by 63.4. 16.35 into 3 divided by 63.4, which is 0.77. So our cost of debt will be 12% plus 0.77%, which is 12.77%. Some rounding up here and there, it's quite possible. That's absolutely okay. Yeah. Are you all following how to calculate the cost of debt? Yeah. Overall steps. So you can just form an equation like this, right? And then you take a rate, calculate the total. If it is more than what you need, you'll obviously increase the rate, and then you take the RHS. Then you simply write down that somewhere my rate is going to be in between the calculated values, and for that sake, you just take the change in rate and then change in the RHS, right? So change in rate upon change in RHS, that will give you the required percentage change. cost of debt will be 12.77%. Right? It's 16.35. It's not 16.35%, it's 16.35. The required change, this is essentially computed by it's 916.35 minus 900. Because we want it to be 900, right? So we want to change from here to here as 16.35. Got it? That 16.35 is the required change because we want to reduce the rate from 916 to 900. How to decide which rate is to be assumed in the exams to get the most accurate answer? Rates will be given to you in exams. Rates will be given to you in the exams. There, maybe 2 or 3 rates will be given. You can just take the highest rate and the lowest rate and then take the interpolation between. Are we good with this, everyone? Yep. Yeah, so that's how we get the interpolation, the rate. Okay. The cost of debt. Yeah. We have done cost of debt, cost of preference share by the shortcut method and also by way of this YTM or IRR. Okay. I will good. Following whatever we have covered today, we have like one more session on cost of capital, wherein we'll be discussing about uh, cost of equity and also some other ways of calculating weighted average cost of capital. With that in mind, let's just call it a day. If you have any queries, you can go ahead. If not, then we'll call it a day. Inquiries, yes. Yes, Malakshmi. Can unmute. Malakshmi, if you have any query. Okay. Yeah, Rishabh. How to remember all formulae? Just write it on a big piece of paper and then stick it on the board and keep on looking at it every morning and every evening. Just like you manifest some loved one, same way you can manifest this formula. Because we are anyways doing all the formula with logic. There's nothing that we need to by heart it or mug it up. There's a logic behind it, right? So you need not worry about remembering. Just need to think about how do we go about applying it.
Sir, I have doubt in ratio.
Ratio, yeah.
Sir, in example 7, what amount we should take in calculation of the fixed turnover?
Calculation of
Fixed turnover, whether to take the after return off or should we take before the return of the fixed asset?
whether you should take the
Fixed fixed asset turnover
fixed
calculation.
asset turnover. You can take COGS or you can even take fixed. You can even take sales. Okay.
No,
So
sir.
if anything of that can be taken, whatever is to be done, the question will specify. If the question is silent, you have to take the sales.
Sir, I'm talking about net assets, net asset in denominator.
Sorry.
So fixed asset, we take sales divided by net assets now.
Yeah. Sales divided by fixed assets.
Sir, in that we should take fixed asset after return of after
After
depreciation.
depreciation. Fixed asset after depreciation.
After depreciation, sir. In calculation of we have to take P&L and after we have to prepare balance sheet. So we
Uh,
have to take the profit balance to the balance sheet.
Profit, you can take it to the balance sheet. That balance sheet profit will comprise of profit from previous years also.
Sir, in
So there the P&L may be a balancing figure or some ratio will be given in the question.
okay, sir. And sir, I don't understand the in example 7 question. Example
Exam-
11. 11.
Example 11 from ratio.
11.
Have you
Yes,
gone
sir.
through the solution?
Sir, no, sir.
No, I've uploaded the solution. Please look into it.
Okay, sir. Sir, and
In case you
in
don't get it, just put it, ping me in the next class.
okay, sir. Sir, in illustration 2, sir, can you explain stock turnover ratio? It was given that 8 times. That way, in answer, they don't take that.
Illustration 2 from the module.
Yes, sir.
Yeah.
Yes, sir.
Yeah. So I'll just take up those things in the next class. So we'll just bring up with that. I'll just maybe complete the session 15 minutes early and then take your questions.
Okay, sir.
Okay.
Thanks, sir.
Okay. Bye. Okay. Let's stop it today. See you in the next class, guys. Bye bye. Right. Yes. Okay, bye bye.